Hey yoke, what is happening and good with my people who I like to call the viewers of the tube? Let me introduce myself as Tyler, and you just entered the crypto focus channel that brings abrupt chaos every single episode, just like the Slavs do in their daily lives. You know how we stop, drop, and roll. It's time for Chico Crypto. Well, I have to cover it as the news wasn't released when I shot my video yesterday. The markets went up yesterday all around, stonks and crypto included, because the Fed announced that one of their newly created purchasing facilities would begin yesterday, buying up $250 billion worth of individual corporate bonds. It came from a press release titled Federal Reserve Board announces updates to Secondary Market Corporate Credit Facility, SMCCF, which will begin buying a broad and diversified portfolio of corporate bonds to support market liquidity and the availability of credit for large employers. So we need to understand how this SMCCF works and what it does, because the importance of our government buying corporations is a dark timeline that will lead to wealth gaps and zombie corporations of the likes this world has never seen. From the press release, the SMCCF will purchase corporate bonds to create a corporate bond portfolio that is based on a broad, diversified market index of U.S. corporate bonds. This index is made up of all the bonds in the secondary market that have been issued by U.S. companies that satisfy the facility's minimum rating, maximum maturity, and other criteria. So first, who is going to be doing the buying? Who is running this facility? The Fed? Nope. As we can see from their latest detail of the facility, the Fed will lend on a recourse basis to a special purpose vehicle, SPV, that will purchase in the secondary market corporate debt issued by eligible issuers. So the Fed is lending this money to an SPV. To who, why, and how much? Well, first let's answer to who and why. From another Fed press release posted in March, they said on March 24th, 2020, the New York Fed retained Blackrock Financial Markets Advisory as a third-party vendor to serve as an investment manager for this facility. Yeah, the Fed and Treasury, they chose BlackRock, the American global investment management company, has been a part of helping our economy for president after president. I love this Bloomberg article. In Think We Trust, BlackRock is now the fourth branch of the government. Yeah, if you didn't know, Larry Fink is the CEO of BlackRock. And in that article, they detail how BlackRock has become so ingrained in our economic and political system. From the article, at the same time, the money manager built a powerful advocacy arm. Its sphere of influence reaches beyond the central bank to lawmakers, presidents, and government agency heads from both political parties. Bloomberg found only a handful of current BlackRock executives who came out of the George W. Bush administration, but more than a dozen Barack Obama alumni. These include Obama's National Security Advisor, Senior Advisor for Climate Policy, the former Federal Reserve Vice Chairman he appointed, and numerous White House, Treasury, and Fed economists. That is literally what is going on right now. There are still BlackRock remnants from the good old W administration, as Georgie Boy was the one who brought BlackRock on in 2008, and that was literally 12 years ago at the end of his term. But then Obama, he loved Larry Fink, the CEO, so he kept him on for his entire presidency. And now Trump, who swears to hate Obama, loves Larry Fink? Whoever believes the bullcrap that Dems and Repubs are not in cahoots together is freaking stupid. They all have the same friends, they all have the same goals, they all use the same techniques to make the rich richer. So BlackRock is a leg of our government now, and Financial Times covered it recently in an article titled How Goldman's Vampire Squid Gave Way to BlackRock. And in it they say, further underpinning BlackRock's power base and its crucial role in the global financial system is its Aladdin technology platform, which connects the world's biggest companies, from banks and rival asset managers to tech giants giants into the markets for trading shares, bonds, derivatives, and currencies. Trillions upon trillions of dollars. All I have to say is what the freak is going on, because back before the crisis hit, BlackRock did some really interesting things, like they knew this was coming. April 3rd of 2019, before any viral craziness, Bloomberg covered what BlackRock was doing in an article titled "BlackRock's Larry Fink Starts Biggest Organization Overhaul in Years." And in the article, it details how BlackRock didn't have an appetite for US corporate debt, shares, and bonds back then, and was looking to other parts of the world. The article stated, the leadership changes reflect BlackRock's desire to cement client ties beyond the Americas. Fink frequently underscores BlackRock's desire to attract customers outside of the US and sees great untapped potential abroad. The company, which oversees about $6 trillion in assets, is also using deal making to advance a goal. It shows how hard it is to find growth here in the US where the market is saturated. Huh? Hard growth in the US? Saturation? Yet now you're running the SPV for the Fed, which is focused on growing and sustaining US corporations. The article also covered back then that BlackRock was beginning to dive into alternative assets. It said, Fink announced a massive overhaul of the firm's leadership, installing new management in its alternative investment division, and reorganizing staff. And deeper into the article, it details just that. BlackRock's alternative push is meant to demonstrate it can be a major player beyond index products, which account for about 2/3 of assets under management. On Monday, the New York-based company said it had completed its first fundraising round for a private equity vehicle. The long-term private capital fund secured $2.75 billion from investors. Private equity vehicle, special purpose vehicle, PEV, SPV, sound similar, like they could be intertwined? It's because they are. There is no doubt about it in my mind. May 25th, 2020, only 3 weeks ago, another Forbes blogger posted this article, Hertz, High-Yield ETFs, and the Fed. And in it, it details that Hertz Corporation, the American car rental company, filed for bankruptcy on May 22nd. That article then details the SMCCF and how BlackRock is involved, and they could purchase ETFs through the facility, as they have been doing that, buying ETFs and not individual corporate bonds for over a month now. But then in the article they say this, as of Friday, May 22nd, HYG, a BlackRock high-yield ETF, held 0.03% of its assets in Hertz bonds. So that was posted in May, and looking at the bond, it crashed into oblivion and was below the $10 mark in May for the 6% bond. But since SMCCF saved its arse, the bond has over 4x, and it's now trading above $35. Obvious portfolio save? In my opinion, oh heck yes. And the woke are actually speaking up about this. Article from Vanity Fair posted 2 days ago. This is just freaking unbelievable. Bankrupt Hertz is a pandemic zombie. And then Robert Pedoni of Zero Sum Trading tweeted, this Hertz isn't gonna go down in the record books. A company in bankruptcy just found idiots to buy their stock before it probably goes to zero. Unless some miracle gets pulled off, they just sold you a valueless piece of paper for $2.50 a share. Laugh out loud, even Enron didn't try this. A miracle, Robert? You mean like a BlackRock miracle? As BlackRock is highly exposed to Hertz besides the high-yield ETF. BlackRock literally just last week disclosed their full holdings to the SEC, and they own 3.7% of Hertz, which includes over 5.27 million shares. And now, here we go. Yesterday, BlackRock got the power to not just buy ETFs, baskets of assets put together to spread out the risk, they get to buy individual corporate bonds. They can hyper-focus where they put this money, into specific companies like Hertz, where risk is enormous. How much risk is BlackRock getting to play around with? Well, the New York Fed has a great FAQ on the SMCCF, and it details just that. It says, the Department of the Treasury, using funding from the Coronavirus Aid, Relief, and Economic Security Act, CARES Act, aka money printed from the Fed, will make a $75 billion equity investment in the SPV for both of the CCFs. The initial allocation of the equity will be $50 billion toward the PMCCF and $25 billion towards the SMCCF. $25 billion, that is all no from the FAQ. The combined size of the CCFs will be up to $750 billion, and $250 billion is for the SMCCF. Huh? How in the hell does that happen? Well, that happens when you get to play with leverage, my friends. It says the SMCCF will leverage Treasury's equity at 10-to-1 when acquiring corporate bonds of issuers that are investment grade at the time of purchase, and when acquiring ETFs whose primary investment objective is exposure to U.S. investment grade corporate bonds. The SMCCF will leverage Treasury's equity at 7-to-1 when acquiring corporate bonds of issuers that are rated below investment grade at the time of purchase, and in a range between 3-to-1 to 7-to-1 depending on the risk when acquiring any other type of eligible asset. And when you see where this money is being put to help, you understand why it's such a dark timeline. Unemployment rates for May paint the picture pretty damn clear. Leisure and hospitality, the highest percentage, which are the lower wage employees. Other services next, low wage employees. All top employment categories are for lower wage employees. Blue collar, higher paying construction, manufacturing, etc., they got hit but less than the lower paying jobs. And then the highest paying jobs, they got hit the least. Government jobs and financial services, but also agricultural jobs. But you can't trust that because the majority of their workers aren't even on the payroll. And wouldn't you think with over $500 billion more dollars issued in those PPP loans, Paycheck Protection Program, not these facilities we were just talking about, these unemployment rates would be getting back to normal by now, right? Well, they didn't go to who they were supposed to, as it's been covered last week. The Trump administration is adamant about keeping who received the loans confidential. But luckily, Politico gave us an article and we can find out who were some of the recipients. And we now know a few members of Congress received them. Members of Congress took small business loans, and the full extent is unknown. In their article, it says at least 4 members of Congress have reaped benefits in some way from the $500 billion small business loan program they helped create. And no one knows how many more there could be. And we probably won't figure it out until this administration is gone, if ever. But we do know it was a bipartisan effort. Republican Congressman Roger Williams of Texas, and a Republican Congresswoman Vicky Hartler of Missouri. The Democrats, Congresswoman Susie Lee of Nevada, and W. McCarcel Powell of Florida. Which leads me to this. All I have to say is with each day, each headline, each investigation I do, my head hangs lower. I mean, first we learned of massive corporations using the small business funds, and now we are learning of our own rich son of a biatch members of Congress dipping into it too. Something has to give here soon, or we will dip into abrupt chaos. Cheers. I'll see you next time.